News just out from the Fed is on the Fed governors who dissented at this week's meeting. Steve Liesman joins us right now. He's got more on that front. Hi, Steve.
Hey, Governors Waller and Bowman continuing that tradition of explaining their dissents on the Friday after the meeting. And they're both saying why they wanted or preferred a quarter-point rate cut. Waller saying that tariffs are one-off price increases and do not cause inflation, echoing speeches he gave before the meeting. He said standard central banking practice is to, quote, look through price level effects. A host of data, he says, argues that monetary policy should be close to neutral, not restrictive. He cites GDP at 1.2% and the idea that it's expected to be softer for the rest of this year. He says inflation is close to target, quote, if we put aside tariff effects. And he believes they'll be temporary. Both he and Bowman are going to talk about that, this idea of an ex-tariff inflation calculation, including expected data revisions. Payroll growth is, quote, near stall speed. And there's downside risks to the labor market, and they have increased. And we should not wait until the labor market deteriorates before we close. And if we could just go right away, by the way, to the Bowman comment, she makes very similar remarks regarding this, where she says inflation has moved considerably closer to our target after excluding temporary effects of tariffs. Economic growth has slowed markedly, she says. Labor market showing increasing signs of fragility, and a neutral setting for policy is the right way to go. I'll leave it there, guys, except that she also says that a cut would have hedged against this weakness. So making cases, there are economic cases for cutting that are not crazy. There's some logic to it. And it's just a matter of this idea of tariffs being one-off price increases that the Fed should look through now, and how much real weakness you see in the labor market.
Well, and that was Joe's point. We're going to get a read on that at 8:30 with the jobs report. If there's more weakness in the jobs report than anticipated, that would bolster their case.
You still read Larry Lindsay when he publishes them? I'll send it to you. Larry Lindsay, the economist.
Once in a while. Not all the time.
It was just pretty interesting.
Smart guy, though.
Very smart, and talking about the surprise drop in import prices and how that works. Pre-tariff, when you exclude tariffs, even though service imports were up, you would think both of them would have been up because of a weaker dollar. You would think it would both. Right. And his point was it almost looks like exporters at this point are eating a lot of the tariffs, which is the whole idea of that in a perfect world, that's what you would hope would happen, right? Yeah. And then you could actually say that the countries are actually paying the tariffs.
Joe, can I just give you a comment that we got? We do our CFO Council meeting. I do a briefing to our CFOs every time before the Fed meeting. If you want to join that CFO Council, you can listen to that briefing.
When is it? It's
at 9 o'clock. It's with the Fed survey results. So we give them a briefing on the Fed survey
results. In the morning?
After we break it here on Squawk, we do it to the CFO Council.
At 9 a.m.?
9 a.m.
That's like nap time.
Right away, right after the show. Boom, you're down. Okay, but here's the thing. One of them said to me, do you really think our suppliers, our distributors, have 15% of extra margin to give? Yeah, are we really that bad in terms of looking for
it's not on the lowest? It's not on the price. It's not on what they're selling. It's on what's coming in. So if their markups are 300%, 400%, it's only on the wholesale price.
Whose markup?
But it still hurts your margin.
Whose markup?
It hurts it a little bit. Like, okay,
it may not be
the tariff is on the wholesale price that the retailer's bringing in.
Okay, so if you are a high-end...
So if I think you're missing my point.
No, if you're bringing in something for $3 and you get a 15% tariff, and then, so what's that, $3.45, and you're selling it for $25 or whatever.
But the thing is, that's not a big deal if you're an Hermes or somebody who's doing it.
You're talking about the highest margin stuff. $3.25 is the craziest margin I've heard.
The point I was trying to make is just the Chinese supplier or the... Or where is it 15% now? I don't even know. Let's say Europe or whatever. Yeah. Does the European supplier have 15% of extra margin to give to absorb the tariff? That's what this person was saying. Now, I've always maintained, Becky, that there are 4 points along the chain that could absorb some of the tariff.
Right, which means each of them is going to take a little bit of the hit. Right. That's better. But if you're talking about grocery stores where your margins are 1% to 2%,
nothing.
That's all the way at the end of the chain. Yeah. There's the exporter, there's the importer, there's the retailer. Any one of these things. Plus, Joe mentioned currency can also absorb some of this.
That has
There's a lot of places.
The dollar's been weaker.
A lot of places. But you also see, interestingly, in Bowman's comments, who said, if you take out the tariff effect, we're at 2.5% or lower PCE inflation. So she's telling us there's 0.3 percentage points at this point of inflation from tariffs.
So
is that a lot? Is that a little? Is there more to come?
So if you had a weak labor market and you got all this other stuff, you should cut.
If you feel confident that what's happening in inflation is not going to
down the road, because the Fed's main road is
listen to Becky Quick.
Make sure they keep inflation from getting out of
right.
Well,
Except that clearly the president thinks that he's about to create a problem.
I think right.
I'm going to walk off and let you guys argue amongst yourselves.
He thinks that the problem will pay benefits in the long term, obviously, in a lot of.